You know, everyone is waiting for February 1st to buy budget stocks. But honestly, by then, it will be too late. The real money, yeah, it's made in the 45 days before the budget. So, the RBI just cut interest rates by 25 basis points this week. Plus, the Deloitte budget report is out. The signal is pretty clear. The government is shifting focus to 3 specific sectors for 2026. In this video, I am decoding the pre-budget strategy. I'll show you why defense, green energy, and one surprise sector are about to explode before January ends. And just a quick disclaimer, please remember this isn't financial advice. Always do your own research before making any investment decisions. Here's the proof in detail. The date is December 5th, 2025, which falls on a Friday. The event? The RBI Monetary Policy Committee, led by Governor Shaktikanta Das, or whoever the current governor is in 2025, voted unanimously, that's 6-0, to cut the repo rate. So, here are the numbers. The old rate was 5.50%, and now the new rate is 5.25%. That's a cut of 25 basis points. And just to put it in perspective, this was the 4th consecutive rate cut in 2025, which brought interest rates down by a massive 1.25% in just 1 year. A repo rate of 5.25% actually takes us back to those pre-war Russia-Ukraine levels. We are, officially entering what's called a cheap money cycle. Why does this matter? Well, the repo rate is basically the interest rate at which banks borrow money from the RBI. So, when the RBI cuts this to 5.25%, the cost of funds for banks like HDFC, SBI, and ICICI drops immediately. Since October 2019, all new floating rate loans, like home or auto loans, are legally linked to an external benchmark, usually the repo rate. The result? Banks are required to pass this 0.25% cut to borrowers within 3 months. It's automatic. No extra effort needed from your side. Here's the scenario. For a 50 lakh home loan over 20 years, before December 5th, when the rate was around 8.5%, your EMI was 43,391 rupees. After December 5th, with the rate at about 8.25%, your EMI drops to 42,603 rupees. Now, the saving, you're looking at 788 rupees saved every month. Over the lifetime of the loan, that's nearly 1.9 lakhs in total interest saved across 20 years. And for auto loans, let's say a 10 lakh car loan over 5 years. The EMI drops by about 150 rupees per month. It might sound small, but honestly, psychologically, it pushes those fence sitters, the people waiting to buy, to finally sign the check. So, when the RBI gives you cheap money, don't just sit on it. Invest in the companies that are selling the products people buy with that cheap money, homes and cars. Ask number 1. The Critical Minerals Fund. Deloitte explicitly recommends creating a dedicated critical minerals fund. This fund is not just for research, it is for overseas acquisitions. They want the government to give money to Indian companies to buy lithium and cobalt mines in Africa and Australia to secure the supply chain for batteries. Ask number 2. The MSME Stabilization Package. Deloitte calls for a large-scale stabilization package to counter global trade wars. The core recommendation is to double the credit guarantee coverage and create a distressed asset fund to stop small businesses from going bankrupt. Why this matters? For NTPC Green Energy, the so-called green angle, here's the problem. NTPC Green has a target of 60 gigawatt capacity, but solar panels and battery storage require massive amounts of lithium and rare earth elements. Right now, we import these, which really kills margins. The budget catalyst? If the finance minister announces this critical minerals fund, it basically subsidizes NTPC Green's raw material costs. The logic is simple. Secured cheap minerals mean lower battery cost, which means higher profit margins for NTPC green storage projects. So, let's talk about Shriram Finance and Bajaj Finance. And honestly, this is all about the lender's perspective. The biggest headache for MSME lenders is, well, bad loans or NPAs. If a small factory shuts down, Shriram Finance ends up losing money. Simple as that. Now, here's the interesting part. The budget catalyst, the so-called stabilization package, comes with credit guarantees, or CGTMSE. What this means is, if a small business defaults, the government actually pays the bank back, not the shareholder. The logic is pretty straightforward. Zero risk on MSME loans means lenders can lend more aggressively, and that could lead to massive loan book growth in the first quarter of 2026. Okay, so here's what happened. In late November, Nifty touched an all-time high of 26,325. But honestly, this wasn't a really strong buy signal. It was what we call a euphoria top, and it was driven by just 3 or 4 stocks like HDFC and Reliance. Now, let's talk about the golden support at 25,758. Why does this number matter? Well, on December 10th, 2025, Nifty closed at 25,758. And trust me, this isn't just some random number. The technical secret here is that this level aligns perfectly with the 50-day exponential moving average, or EMA. Every time Nifty touches this 50-day EMA line in a bull market, it tends to bounce back up. We just touched it yesterday. Plus, there's this matching low pattern on the charts, a double bottom formation near 25,700, which basically confirms that sellers are exhausted and buyers are stepping back in. So, what's the why buy now logic? Well, the recent dip happened because investors were super nervous about the US Fed policy. But now, the Fed event is over, with a 25 basis points cut, and all that uncertainty is gone. History shows that once the event risk, like a Fed meeting, is removed, the market usually rallies. We're buying right at the moment the fear ends, and honestly, right at the strongest support level of 25,700. Hey, if you found this helpful, don't forget to like and subscribe to the channel for more videos like this.